Hi everyone, I am Dr. K. Amudal, Assistant Professor in Commerce, PPG College of Arts and Science, Coimbatore. Today we are going to study income from house property, one of the 5 heads of income under the Income Tax Act 1961. This topic is very important because many individuals own houses, flats, or commercial buildings. Rental income received from such properties is taxable. Understanding the rules helps taxpayers calculate their tax correctly and legally claim deductions. By the end of this session, you will understand meaning of house property income, sources of house property income, method of calculating taxable income, available deductions, practical example, tax treatment under the income tax. The next one is, what is house property income? House property income means income earned from owning buildings or land attached to buildings. Under the Income Tax Act, 3 conditions must be satisfied. First condition is there must be a building or land attached. For example, house, apartment, office building, shop, warehouses. Then second one is taxpayer must be the owner. Ownership may be individual, Hindu undivided family, company, partnership. Third one, property should not be used for own business. If it is used for the owner's own business, the income is taxed under profits and gains of business or profession, not under the house property. Thus, ownership is the key requirement for taxation under this head. Sources of house property income. House property income may arise from different situations. First one, residential rental income. This is not received from flats, independent houses, apartments. Example, a person rent his house for 20,000 per month. Annual rent rupees 12,000 into 12 months, 2,40,000. Commercial property income, the second one. Commercial buildings include shops, offices, warehouses, industrial buildings. Rent received from these properties is also taxable under the house property. Third one, self-occupied property. If a person lives in his own house, no rent is actually received. Generally, under current Indian tax rules, one or more self-occupied properties may have a nil annual value. Subject to applicable provisions, the concept of notational or deemed rent applies mainly in specified situations rather than to all self-occupied houses. Thus, not every property generates actual rental income, but the law prescribes how each type is treated. Next one is calculating house property income. Calculation of house property income follows systematic steps. Step 1, find gross annual value, that is called as GAV. Gross annual value means expected or actual rent. For example, monthly rent rupees 25,000, annual rent rupees 3 lakh. The next step is subtract from municipal tax. Municipal taxes paid by owner are deductible. Example, municipal tax 20,000, net annual value minus municipal tax. But 3 lakh minus 20,000, 2,80,000 is net annual value. Then step 3, deduct standard deduction. Income tax allows 30% of net annual value as deduction. 30% of 2,80,000, rupees 84,000 is net annual value. Step 4, deduct interest on home loan. Suppose interest is rupees 1,20,000. Step 5, net taxable income rupees 2,80,000 minus 84 minus 1,20,000 is equal to the answer net taxable income is rupees 76,000. This is taxable under income from house property. Next one, tax treatment. Now let us understand how tax is applied. Rental income is taxable after deducting municipal taxes, standard deduction that is 30%, interest on housing loan. For self-occupied houses, annual value may be nil if conditions under the Income Tax Act are satisfied. Important documents include rent agreement, municipal tax receipts, loan interest certificate, property ownership documents. Maintaining these documents helps during the income tax return filing and assessment. Real world example. Let us solve with a simple numerical problem. Suppose annual rent is rupees 14 lakh 40,000. Municipal taxes 1 lakh 20,000. Net annual value 13 lakh 20,000. Standard deduction 30% of net annual value. The net annual value is 3 lakh 96,000. Interest on housing loan is rupees 2 lakh. Taxable income 13 lakh 20,000 minus 3 lakh 96,000 minus 2 lakh is equal to 7 lakh 24,000. The amount is taxable under the head income from house property. This example demonstrates each calculation step clearly. The last one is summary. Let us revise today's concepts. We learned meaning of house property income, conditions for taxation, sources of income, residential property, commercial property, self-occupied property, calculation of gross annual value, net annual value, standard deduction, interest on home loan, taxable income. Remember the formula is gross annual value minus municipal taxes equal to net annual value. Then net annual value minus standard deduction 30%, interest on home loan. Finally, we get the income from house property. Understanding these rules helps taxpayers calculate income correctly, claim eligible deductions, and comply with tax laws. Thank you. Thank you for watching.